In this video, we're going to be looking at the concept of trends, and some of the objectives discussed include the definition of what a trend really is, and we will divide them into the two types of trends used specifically for investors. We've got consumer and investor trends that differ slightly but can be used in conjunction to help make more efficient investment decisions. And we'll be looking at some of the factors and elements to consider within those different types. We'll also have an example of the rise of a big trend which now can be found through cryptocurrencies, the rise of crypto, so Bitcoin and Ethereum, etc. Even things like Ripple, but we're just going to focus on those two in terms of their rise later on. And we will also ask ourselves the question and answer this: why do we observe trends in the first place? So let's begin. We're going to first answer what trends are in business in general. And it's not to be confused with trends in technical analysis, because a trend on the fundamental side of things accounts for the identification of a direction in which focus is changing. And the two main types of trends are classified as follows. We've got consumer and investor trends. By consumer trends, these of which are found by conducting analysis of consumer buying patterns with relation to goods and services, and investor trends of which are found by identifying popular niches or sectors where investor funds are heavily concentrated. So let's now look at some of the factors influencing each of the trends mentioned above. So let's get a graphic up real quick. If the general population of a nation happens to be struggling financially, you've got figures such as earnings and thus disposable income will be quite low. So as a result of this, cheaper and more efficient solutions to problems in a person's daily working life are more likely to catch on and access a larger market when launched. So an example would include, let's just imagine you have a targeted bit of marketing of a couponing add-on like Honey or something, a service to such individuals of whom would benefit from the financial savings to be had. And depending on the economic situation at the time, consumer spending fluctuates between stronger levels in periods of strength, economic strength rather. Buying higher priced items seems to be something that occurs a lot more because people are wealthier, people have a lot more disposable income, and weaker levels in periods of economic weakness where people are buying low ticket items, essentially cheaper goods and services. Let's now move to a behavior with regards to consumer trends. These behavioral factors account for psychological, cultural, social, and personal influences on a person's decision making. Trends can die out from consumers letting go of a hype, but these people can also support new concepts and get behind the next big thing. So consumers recently, for example, have shown interest in electrical vehicles. Many listeners may be familiar with Tesla, and the Tesla cars out there have had increased awareness of global warming, not specifically the Tesla cars, but with relation to electric vehicles. Humans as consumers, we've had awareness. We want to have less of a harmful impact on our society. So what a lot of people have been doing is they've switched away from the traditional vehicles that have those traditional engines that produce harmful gases because of that awareness of global warming. So people have transferred their interest to things like electrical vehicles, and some are willing to pay more money even though they're not sure if, say, the concept is proven or whatever. But it's important to understand how long a trend will go on for, because with electric vehicles, as we've just discussed, we must consider things like that battery life I just mentioned about the engine. If you believe the trend to have longevity, this word is here, really important. If you believe a trend to have longevity, you're assuming that the electrical vehicles will outperform what's currently out there. Otherwise, the concept lacks longevity, and the term longevity suggests that something has a long life. Longevity. One would like to have a happy and a long life. A bit of longevity there in real life context. But it's also important to remember the elements of the important factors, and we will look specifically at consumer trends before we move on to investor trends. So let's get one bit up here. For economic elements, we have employment, wages, and consumer confidence levels. That specifically accounts for just consumer confidence, how confident the consumers are in spending. The most important measure of a person's own financial spending capabilities can be seen through their proportionate disposable income. The disposable income. That's what's left over after you take out taxes. And there are other measures like total savings. If you've got a lot of savings, then maybe you're more likely to buy higher priced items, and trends will be towards such things. Companies launch products and consumers act accordingly. And investment funds. If you've got a lot of investment funds, that likely seems to be the case. But if we have the behavioral section here, there are psychological factors that play on an individual's psyche, and they can be divided into two categories. We've got conscious and unconscious decisions. Whilst we haven't put them here, these ideas here can be divided into conscious and unconscious decisions, and it's kind of key in the name. Buyers of a particular brand sometimes may purchase a given product without a specified reason as to why they are buying it. Products can be ideally priced for impulsive purchasing decisions. So think of the last time you went to do some grocery shopping. Remember that moment where you felt like getting a quick something to eat, maybe a snack. You had dinner ready at home, but for some reason, you couldn't resist the urge for some impulsive snacking. So by doing this, you made an expenditure, probably without a reasonable explanation, but that's totally fine. We're human at the end of the day, and thus we rely on both conscious and unconscious thought when making a decision. But hey, cultural differences, if we can move on to this point, beyond a kind of psychological thought, they may warrant constraints for the expansion of a product in certain markets. So trends may be affected by such things. So let's give an example. Say a restaurant that sells burgers happens to open in a predominantly Muslim area, and let's just say they don't have an offering that caters to this particular group. Well, to increase sales within this demographic of diners, it could be an ideal option to offer a halal option on the menu. Gets more sales, the trend is there, there's a growing audience in that particular area. You would look to see that accounted for in that area. And then there's more money to be made from the existing product plus the additional product that is launched by the business. So the same principle goes for social elements. These are these social elements within the behavior section. Say a large demographic in a given area happens to be vegan, and local restaurants offering meat-based products without a suitable alternative may not perform as highly as they could if they were to implement something like, I don't know, a corn-based product, so something that incorporates the vegan diet and creates sales for the business. So restaurant brands, for example, if they are adapting to such things, then that's a good sign. If they're not, brands that don't adapt in general, Debenhams is one, if many people have been following them. They didn't adapt, the business model died out, it focused on paying back debt, and things just didn't work out. You didn't adapt, you didn't work, and you weren't on trend. The trend kind of went to online. But we will talk a little bit more about that and the online versus retail model when we are in our video about business models that is also available in the Fundamental Analysis Essentials section. So, for personal elements now, we should probably talk about those that bit. We could use the example of learning. So some people prefer learning online. I prefer learning online. Others may prefer to read physical books. And you'll even see people who like to learn things by listening to podcasts and other audio to further their knowledge. They have personal choices, and that's where the trends are. For example, Spotify has a huge market at the moment of people listening to podcasts, but also, people like to listen to music and stuff, and they are catching that trend, and thus the value is being captured for their brand. But hey, we must also ask ourselves some questions to determine the strength of a new trend. So the first in this section of trend longevity looks at the issue of declining sales, because an ideal scenario would be to have a newly launched product making repeat sales. You'd also look, though, to see a good growing market. You'd question yourself saying, what is the market growth rate of a certain, say, product or a certain sector where you've got consumers? But aggressive growth creates a risk of overly optimistic future growth forecasts. But ultimately, if the new trend solves a problem for many, thus creating value for consumers, there may well be significant longevity within. So now we're going to look at some important factors to consider for investor trends. We'll put the three ones up here. You've got overall market, sectors, and companies. The main one, overall market, can be defined by really a risk on, risk off phase. I'd like to put it that way, where you've got assets being poured in or assets being taken out of the market. Assets that essentially are risky are getting taken out on a risk off phase, which we'll talk about in a bit. And on a risk on phase, people are buying risky assets, and you'll see stock market indexes normally rising, kind of correlated with strong and weak markets. Strong markets, risk on, weak markets, risk off. And we'll go through this again, but we also have sectors where you've got sector trends that can be seen through new areas of business. So for example, in the medical cannabis arena, and even with electrical vehicles that we just mentioned before. If you love the story of a particular sector, there are opportunities to invest in things like thematic ETFs. These track quote-unquote story stocks, and buying such financial products enables you to have exposure to a sector you like. So one example could be, you think that the population is aging, you can have an example of something like healthcare through an ETF, but that's a separate section that we could explore in further detail, and we will do in a separate video regarding ETFs. But hey, once you've analyzed emerging trends in the different sectors of a market, it might be a good shout to look at the companies themselves and maybe keep watch of new IPOs, so initial public offerings. That refers to when a company first gets listed on a public stock exchange. Companies like Tesla, of which many investors are familiar with, have been around for a good few years and yet have delivered impressive returns to their shareholders. You can't say, I saw this happening and not be invested, because you had plenty of time to be invested in something like that. It's a situation of it wasn't cut off to investors. You are able to get yourself involved. And a big contributor to Tesla's returns lies in the company's consistent sales growth in international markets. They've kept on trend, and thus they've reaped the rewards accordingly. And they are deserved rewards, especially given the overall market sentiment about that particular stock. There was a lot of a bias on the short side, yet the shares have performed and been really rewarding for long-term investors in the shares, especially the CEO himself, Mr. Elon Musk. But hey, we will now look at some of the elements of the important factors within investment trends. So we mentioned the whole risk on, risk off phase about the overall market, and we've got some elements within that also help. We're just going to go through risk on and risk off again, just to make a little bit more sense of it. So risk on accounts for when investors pile heavily into, quote, risk assets. So things like stocks, real estate, and commodities like oil that carry significant risks. Remember that, significant risk. When you're risk on, you're taking on a lot of risk, but that's because you're quote unquote bullish on the market. But on the other hand, the risk off phase accounts for when investors shift focus onto assets like gold and silver and bonds too. Bonds are really important ones to remember. And there are bits of data that can be used to get an understanding of the wider market environment. So whilst we've included some examples here, the put-call ratio, the AAII, and the VIX, there are some other ones that we could probably mention before we look through these. I mean, one example could be through the advanced decline ratio. That's a nifty tool that displays how many stocks closed up versus those that closed down in a day's trading period. But if we look at the things we've got over here, we can see that the put-call ratio details the distributions of puts, which refer to the right to sell, and calls that refer to the right to buy. When a market is heavily weighted towards the call side, so you have a larger proportion of people putting calls in the market than puts, it signals investor bullishness, because remember, a call is the right to buy. If you're buying calls, you're buying the right to buy at a higher price, and if the index pops above that strike that you've put involved, and then you make above what your premium is something that you're putting up. This may sound like a complicated concept, but we will explain this accordingly in a separate area too. But if that price goes above where your break-even point is, including that premium being accounted for, you make a fair bit of money without having to put up too much risk initially. So a lot of people having calls shows the investor bullishness or widespread bullishness. And likewise, when the weighting is greater on the put side, investors are generally having negative overall market sentiment. So for the AAII, which we have here, you don't really need to know what it stands for, but we should know that it is a weekly survey of investor sentiment. And from this, we can extract the opinions of other investors and traders in the market. And we've got the VIX as well here as an additional tool. This is a measure of, well, it's called the volatility index. So it's a measure of how volatile markets are. And what you need to know is that if the VIX rises sharply, it's usually correlated with added market-wide uncertainty. You generally see the VIX drift lower when markets are thriving, and a good hedging strategy, this is for those who want to go the extra mile, could include trading the VIX by buying call options at higher prices. Say if you've had, as we had before we had the downturn, a consecutive set of years. We had about, 9-10 years of strong market gains before having a heavy correction. And if you bought calls, so call options, at say much higher prices on the VIX, the volatility index, expecting that volatility to shift up, you would be able to protect your portfolio against losses from a downturn in the overall market. But once again, as I mentioned earlier, we'll discuss options in further detail in a separate video. So with regards to sectors, there are three main areas. There's not too much that we could really worry about here, but with the technical side of sectors, you could chart different sectors, say the oil sector using, say, a US-based basket or a UK-based one, which you can use ETFs for, all sorts of things, and then get an overall view of the market. You could look at different sectors and use different moving averages, say your generic 100, 250, etc. Maybe even shorter term moving averages, simple moving averages, exponential, whatever. You can be creative, but make sure you backtest everything you do. Fundamental analysis of sectors, you could have these fundamental shifts where margins are improving as a result of, say, commodity prices improving. So when you had, we could give an example of CAS Minerals. We've used them on a couple of charts for the TA series. CAS Minerals is a miner, and they have the majority of their revenues coming from copper. I think it's around 80 to 85% coming from copper alone. When prices have improved, for example, recently, that's probably not a great example, but let's just say they also have a bit of gold. They've got 10% of that area, and then the rest is kind of zinc, but that 10% is in gold. And on that part, gold prices are above 50% in terms of gains for the year, I believe year to date. And they're approaching 2,000. They were roughly 1,400, 1,500 at the beginning of the year. That 10% is going to have much better margins. And thus, you'd look at gold producers across the board and you'd think, okay, these guys are doing quite well. And I can only assume that the whole sector is going to have some form of turn to the upside. So you look at those deeper fundamental things in the sectors and then you screen deeper. So sentiment is also an important thing, where we could say if investors have really dodged, for example, oil and gas stocks in 2016, they weren't a fan of it, especially with oil prices for Brent going as low as, I believe, $30, $27 even. And most break-evens were around $45, $50 a barrel. So businesses weren't able to make money. And when oil prices recovered above that point, they had large amounts of debt, and people weren't, as investors, weren't able to quote unquote have trust for the industry because of debt servicing costs and all sorts of things. But the fact that sentiment recovered at a certain point was then when you could start looking a little bit deeper, realizing that the sector maybe is turning to a positive side. Sentiment kind of lies in with that technical side and the fundamental. Everything's used together in conjunction to create a valuable opportunity. And we'll finish with companies. We've got IPOs, as we mentioned earlier, with electric vehicles. Not just specifically electric vehicles, but new businesses are being put up. For example, Spotify IPO'd about a year ago or so, And we have a lot of businesses that are doing similar things with new technology, and valuations are, quote, exuberant, but some would argue they are fair in these cases. But with investor trends, IPOs are normally things that have that quote unquote spike period, as we'll see with the graphs we use later to show crypto. You have that huge spike period, and then you have a cool off, an eventual cool off. Commodity prices, we kind of mentioned earlier on the fundamental side with sectors, but with companies, we could use the example of CAS, for example. If copper prices exploded, their proportionate sales are at 85% of all revenues that come in. So they would probably win relative to, say, someone that's mostly a gold miner, if only copper prices popped, but gold prices didn't as much. You see what I mean? You have to look at things relative and then determine and divulge trend from it. Takeovers as well. If companies are rumored to be taken over, then it's likely that investors are flocking into them. BT recently was an example. There was a rumor of a bid or something like that, and shares popped 5% overnight. Nothing huge, but once again, these kind of things happen. You have a lot of takeover rumors as well with businesses before they go into the ground, which one must be careful of. Not everything you read on the internet is entirely true. But dividend yields are also important because you have pension investors. They sometimes solely invest into quote unquote liquid companies, companies that meet liquidity requirements to do one thing, to get a regular income. Because if you have a pension, you will look to, say, take a lump sum out at some point in time. And by doing that, you are exposing the pension firm to money being taken out. And when that money is taken out, they have to account for it. So the only way they can account for it is building a cash pile through dividend yields. That's one of the main ways, and they have other ways of making them too. But a trend could also be seen by dividend yields, because a lot of investors invest in things purely for the sake of dividend yields. That, once again, is a controversial topic that we discuss on a separate occasion, but it's important to consider the impact of dividend yields on trends as well. So we'll give an example here of cryptocurrencies and the rise with Bitcoin. A little graph here. You've got the lows just before the trend kind of took off. You had futures contracts being traded around here. This was January 2018. And it's not the first, because this is a monthly graph of Bitcoin against the dollar. And for the whole month of January, we can assume at some point the high was hit at $25,200. Bear in mind the lows were at $210 just not even 3 years prior. It's amazing how these things even happen in the modern day. There was 119 times return on the initial investment if someone were to get in at those lows. Obviously, it's hypothetical. It's not guaranteed to get in under that circumstance and the such favorable conditions. You'd maybe sell double your money. You'd make 10 times your money. You'd be happy 20 times. But 119 times? And why would you get that specifically? It's not normally something that'll work. But it's interesting to see such an exponential rise within a short period of time. It was an 11,900% increase from lows to highs, as we've quoted. It's pretty interesting. And this is for Bitcoin. Now, you think Bitcoin was crazy with 119x. Try looking at Ethereum. We have a 3,889 times increase from your initial investment if you were in around the same kind of period for the lows, the 1st of October 2015, which is a little bit earlier, or actually a little bit later than the 1st of August, I believe. Let's just get that up. 1st of August 2015, yeah. So that is really, really amazing. 41 cents. This is in US dollars, Ethereum against the US dollar. 41 cents to $1,594 or $1,594 and 89 cents. And that was on the 1st of January, or the month of January 2018, because this is a monthly chart. Each candle represents a month. A 388,898% increase from lows to highs. Amazing stuff. But the problem is, imagine the majority of a herd would be buying at that point and you would be out, unfortunately, taking big losses. But people being early into such big trends can make a lot of money. You can stand to make big money, which is amazing. Absolutely amazing. who knows what the next thing will be, but it's just cool to look back at such things too, to kind of gauge our mind as well. But hey, look, why do we observe consumer and investor trends? We must keep ourselves thinking. And I would say it's to keep up to date with new trends. And that helps us generate these new trading ideas. And all it really takes, with the Bitcoin example and the Ethereum example we showed, all it really takes is one big idea to ride the wave and make multiples on top of the average expected rate of return for the market, for an investor in the market. And the average expected return, the annual expected return rather, is roughly 8% for most investors. That is called the generic phrase of what you may have heard before, historical market returns, or annualized historic market returns. And we must also act accordingly with changes in both trends, so consumer and investor ones. And by acting accordingly, we could exit longs or open shorts when things change, or do whatever really, a culmination of whatever set up to try and work based off the trend, rotation, whatever. Sectors, for example, rotate, you act accordingly. And to finish, it's crucial on this same point, you act accordingly with it, but you must add to winners. You reduce stakes in the laggers. So it's crucial that you increase stakes in growing industries and you reduce in what we would call the laggards, which are those that fail to deliver growth relative to the other industries out there. And in doing so, you'll be able to become more efficient in your investment practices, and you won't be kicking yourself after you see a big trend begin, and hopefully you'll be able to ride the wave too.